continuing with our analysis on the dollar pairs as well, right? So as you know, guys, we have already spoken about certain things, right? So we have already spoken about how the relationship between the supply and demand, how it plays a role. And we also had a look at the DXY, isn't it? So we had a look at the DXY, and then we actually had a look at the DXY multiple times, which again, we're still looking at it from a daily time frame. We're still expecting a further continuation of a drop, right? Because like yesterday, we did explain the fact that this itself, regardless of how you view it, is still a consolidative state. Are we okay with that? So if we have a clear agreement that this is actually a consolidation state, therefore, that means that like we are currently looking for a further decline in the value of this set asset, which is a DXY. Are we okay with that? So we agree with that, right? Ragwana, guys. I've been up since 4 o'clock. So if you have been up more than up before 4 o'clock, or you've been up since 4 o'clock with me, then I will understand when you're taking time to respond. But if you woke up here at like Boma 6, 7, 8 in the morning, you have absolutely have no incentive to take a longer time for you to respond because you're still fresh, right? So now, if we're going to say that this is a consolidation now, let us continue and then look at other pairs that consist of a dollar as a code currency, and we'll look at those that consist of a dollar as a base currency, right? So yesterday, throughout the discussion, the one thing that we did discuss, right? We discussed how a consolidation is formed, isn't it? We also discussed the role of a consolidation itself, right? And why like a support or a resistance normally form around the consolidative state, right? And then we also had a discussion in terms of like the retracement, what is the main objective behind the retracement? And here we looked at it and then we said that the market did liquidate below or did break below this set area. So now we understand why there is a need for the price to actually push a bit further to the upside, isn't it? So you guys do remember that, ne? Okay, so you do remember that, right? So now, because now the main objective of this is to push price a bit deeper inside the consolidative area, right? So technically, if we were to look at it in its most simplest form, right, we can actually end up saying that this area here, it's actually a excess price, right? So would you agree or disagree? Would you agree or disagree if I said that this is an excess price? Why would you agree? I want to know. I get you said you are agreeing. So now tell me what you are agreeing to. The market broke out of the range and got back inside the range, but the breakout is not significant enough. So you're saying the breakout is not significant enough? So this is not an excess price. You don't have to be like, yes, don't be a yes man. Like you must question, obviously. This is not an excess price, basically. This is actually a breakout. The market did actually break out because like you kind of like have to take into consideration the duration in which the market spent away from that said breakout, right? So because now if we were going to look at it and said that this is an excess price, so if this was supposed to be an excess price, that means upon this spike here, the market should have closed in a bullish, at least should have closed in a bullish back into the set area that we were looking at. but we can actually see that the market spent quite a significant time away from this area upon breaking it. So therefore, we cannot actually say that this is actually a excess price, because an excess price is an outlier. Again, like we spoke, an excess price is an outlier. That means that an outlier, it cannot be an outlier based on, like, for example, you've got 10 solutions that you're analyzing, right? And you cannot have consistency of outliers for 3 of them. Then now you have to go and sample the entire batch, because it shows that maybe there is an error. An outlier, in most cases, it's 1 or 2 samples, but like in most cases, if we were to look at it and say it's an outlier, we'll basically focus on one specific thing and say, okay, this one, there might have been human interference, or maybe I did not sample from the same pool that I sampled, or something must have went wrong during the analysis, right? So this is not an outlier because of the significance of the breakout. The breakout is significant, right? So the longer the market will spend in a consolidation state, the further the intensifies the breakout also do. Okay, so yeah, the longer the market spends in a set consolidations, the more intense the breakout it will be, right? But last time when we spoke about this thing, remember that we also looked at the location in which this is forming. It's very important to understand the location in which the set consolidation is forming, right? So for example, right now, let's say maybe you are looking at it from this, and then you say that, you know what, okay, guys, you know this thing, I don't like this thing of adding people in dollars. It is distracting. It throws me off my game. Right now, as I walk in the Holy Spirit, I do not want anything that can throw me off, guys. When you're praying, man, when you're praying and you are in the zone and you can feel the palm of God upon your head, if something distracts you, you lose the connection, man. Must look at this as like Avatar. Once you connect the tail and you lose the grip, it's gone. I don't know what they call it, that things that they write them. So that thing, you must make sure that, everything you are, so I don't like adding people during the Zoom, guys. So nowadays, when I give you 5 minutes to enter the Zoom, please do so, right? Because right now I have to consistently check so that I don't have to leave others behind, right? So, okay, now, remember that we spoke about the intensity of the consolidation, right? Okay, let's go and look at it. What can we look at that has that similarities in intensities? Okay, sharp. Guys, let's focus. So now, okay, let's look at the 2 types of not 2 types, but let's look at the 2 consolidation, right? If you look at the 2 consolidation, right? Okay, we can just look at it from here. And then you look at it from here, right? Again. Okay, now let's go back. Okay, I want us to look at consolidation. Okay, let me look at another pair that actually can show you this a bit more properly. Okay. Okay. I want to find you a nice one. But, majority of the things have been consolidating. You guys do understand that we are currently trading within a consolidative market, isn't it? You have a clear understanding of where we're currently trading within. Okay, I think this can be a good example, isn't it? I think it can be. Can it be? It can be. Okay, let me look at something with a dollar so that we don't deviate from where we want to go. Okay, so I don't want us to deviate from what we are doing. Please bear with me. Because the thing is that I want to show you based on intensity, right? and based on location, because the intensity of a breakout is directly proportional to the consolidative state, right? Okay, sharp. Okay, sharp. I think I can do it with this one, right? So now, is everyone following? Is everyone still with me? Everyone is still breathing. The heart is still functioning well, right? Because now we are about to look at something. It's not complex, but it's a bit simple, right? Okay, so now I'm going to give you two things, not necessarily two things, but I'm going to give you this scenario, and then I'm going to give you this scenario, right? So now these are two consolidative state, right? And again, I'm going to give you another such scenario. Trading is a very beautiful thing, man. It's a work of art. You know, when you draw these boxes, you feel like Leonardo da Vinci. Is it Leonardo da Vinci or man? You know, you feel like you are in the ancient time, guys. So now let's look at this three consolidative state, right? So we've got consolidation A, we've got consolidation B, we've got consolidation C, isn't it? Sharp. So now out of this three consolidation, right? The fundamental or the core principle or the blueprint of a consolidation, it's roughly the same throughout. Yes or no? The blueprint of a consolidation is roughly the same throughout. Whether the consolidation is horizontal or is skewed, it does not matter. The blueprint is roughly the same. Do we agree or disagree? And please don't be a yes man. If you have a disagreement, voice your opinion. That's why we're here. We're here to learn. Learner want to learn. So what I'm saying is that like the blueprint of a consolidation or the mechanics of a consolidation is the same throughout. Whether the consolidation is horizontal, whether the consolidation is skewed, or whether the consolidation forms at the top or at the bottom, whether you call it accumulation or distribution, the core principles or the core mechanics that makes up a consolidative state is the same, right? Because if we're going to say that the processes that go into the formation of a consolidation are the same, therefore we have to firstly establish what constitutes a consolidation, right? A consolidation, if we're looking at it as a part whereby the market either moves horizontally or it moves skewed or gradually to the upside or gradually to the downside. Normally people will just plot the trend lines and give it a channel, give it a name, give it a channel, give it a pennant, a continuation, pattern, triangle, whatever it might be, right? But at the end of the day, one should understand that a consolidation can be regarded as of a fair value area. So when we say a fair value area, that means that like there is a equal disagreement of price, but yet an equal agreement of value. Do you understand? So if there is an equal disagreement of price, that means that like people are disagreeing over the pricing of the said asset, but the value of it, they agreeing on it. So they agreeing on the value of it, but the pricing of it, they do not agree. Like for example, right now I'm looking at an iPhone. What is the iPhone? iPhone what? The latest one is 14, right? So I'm looking at iPhone 14. Me as a consumer, I understand the value of having a phone, isn't it? But the pricing itself, I do not agree with it. You understand? So the supplier understands the value of a phone, but does not agree on the pricing. So now we consistently fighting over the pricing, but yet the asset itself is valuable to both of us. You understand? For them, it's an asset that can be sold. For me, it's something that I can accumulate in order for me to build my portfolio in everything that I want to communicate with family to do. I understand its value, same as them understand their value, but the only difference we're having is the pricing. So are we okay? But yet again, we're going to reach the middle point, right? Whereby we're going to reach a controlled price, a price whereby both me and him are but again, we are happy, not necessarily happy. You know, when they say that both of you guys sacrifice, the economic term of it, I know the pricing where both they sacrifice. The naming of the I forgot the name of the actual pricing when they say that, like, when two individuals, you know, guys, yeah, something. Is it an economic term? I remember it from economics, but like it's in my, it's just right there in my medulla oblongata. So I just need to go refresh my brain again, you know. That's the thing about this reading things, man. As you go, man, you continuously forget certain things that are very nice. Eh? So you guys say I think it applies to both midpoint, neither party feeling like being overpowered by it. It's not equilibrium, guys. Like, I know equilibrium, ne? Check first. We have all the time. It's December must oh, but price negotiation, price what consumer, not necessarily to haggle, but I think you guys get it, man. I think you guys get it. Sorry for the man thing. It's just frustration in my brain. I think I have to reread these things again. I have to reread these things again. Oh, guys, I need to reread economic things again. I'm sorry about that, but it's not price elasticity. It's not price elasticity, ne? Okay, Sharp, we'll go. This is a task for like we'll do it. We will just go search for it, right? So okay, so now that is the situation, right? Before I even got distracted, this is the situation of like what has occurred. So we have a control price, right? So now again, we're looking at consolidation A, B, and C, right? So when we're looking at consolidation A, B, and C, now the question arises, what is different about this consolidation? Though we understand that the mechanics is the same. I think it is MPC, marginal propensity to consume. Marginal propensity to consume. Not really. I'm not, I'll check. Some of the terms I forgot about them, but yeah. So now the question arises, what is the difference between all three of them, right? Because now what we're trying to answer the depth of a breakout based on a consolidative state, because now again, the breakout itself comes from a consolidative state, right? That is the process of the forced liquidation process, or the process that shifts power from buyers to sellers or sellers to buyers. So now the question we can actually ask ourselves is that, like, what is the difference? Because now, for example, right now, when I am looking at this consolidation, this is consolidation A, based on its location or based on where it's formed, right? Again, I understand that the intensity of the breakout, yes, it was there, right? And this is consolidation B, and I'm looking at the intensity of a breakout. Okay, now I'm looking at consolidation C. I'm looking at the intensity of a breakout. Definitely these three properties are not really the same, isn't it? But yet the mechanism of this is the same. For example, a car is a car. Building a car, roughly everything is the same. But again, now when it comes to the speed, why is this other one more faster than the other one, while this one takes time to pick up speed? You understand? The process is the same. How it's driven, everything is the same. but yet there is a certain element that differs between all of them. So now my question arises, we're looking at consolidation A and B. Let's not even look at C. Consolidation A and B, let's look at the breakout. What is different about the breakout? We understand that the other one is large, the other one is small, but the question is that, like, what constitutes to their differences? Eh? We go into 2023, guys, and these things I've already taught you guys, but right now it's just a refreshment. Are the duration, okay? Okay, means while you say the duration, this is very nice, this is very interesting. Means while you say the duration, question, doesn't, when we spoke about this, didn't we say that the duration in which the market spends in the consolidation, the more intense the breakout it will be, the more intense the breakout will be, because that's what we said. Upon, yes, Prince, you're just pointing out what we just, what we're observing. We're asking the difference. We see the consolidation. Definitely a consolidation is going to be there upon each. That's how the market moves. The market moves in waves. If you are at Durban, please go look at the waves. Maybe you will see that the waves don't move in a straight line, and each and every wave has its own characteristics. It's different but by through observation, when you're looking at them, it seems like the waves are the same, but they're not. Same as the consolidation. You can go to Durban and just relax by the beach and just watch each and every wave that comes. And you just look at it and you say, okay, this one might be bigger, this one might be smaller, this one might be faster, this one might be, it all has different things. You've got the wind, you've got, Evan, yeah, I don't know how to say it, but you get the point. A is horizontal, B is skewed. Okay, we said that the mechanism in which a consolidation form is the same, whether skewed or what, we identify those things. We identify that is the same. The question, or maybe the strength and the price moves away from a consolidation A and B. Yes, but Marokana, I think, okay, I think now comes into play the location in which the consolidation A is at. There was a mechanism in changing the percentage. Thank you, Sean. This is the distance between the support and resistance. Can it be a factor? Not entirely, right? So right now, what Sean said is exactly what I said initially about the location. The location in which a consolidation forms plays a role, regardless of the intensity of the breakout. One it almost like, so if that is the case, now the question arises, the same thing, it's about the location of a consolidation. First of all, if you're looking at it from this area, right? So you have to understand where it came from. Okay, this we understand, right? So as the price breaks below the first area, remember that this itself is a consolidation. As a consolidative state, it plays a huge role. Because now you're looking at this consolidation, right? And as you are looking at this consolidation, this consolidative state, not everyone believes that the market has the probability of reducing in value. Everyone is expecting a further rise in price, isn't it? So once you break below the first key area of significance, what occurs? Once you break below the first key area that is viewed to be of significance, what occurs? What occurs is that now you've got mass liquidation. You've got mass forced liquidation based on the people that recently just took trades upon this push to the upside. Now, again, look at the intensity of the push to the upside. So this thing was not moving with a high degree of speed, no acceleration, no nothing. But here, all of a sudden, you just decided to pick up the momentum. What is constituting towards that aggressive push to the upside? It's not something on the left side. You can't look on the left-hand side. There's nothing on the left-hand side. So now the question arises, what constitutes to this? The question, what constitutes to that? And then now you get to see that, like, okay, now this is an induction phase. An induction phase, again, an induction phase can be created. So someone is willing to put his money on the table just to say, you know what, I might lose a couple of money, but I'm willing to lose that in order for me to generate the necessary amount of liquidity required to push the price to the upside so that I can get a better pricing, so that I can see. Remember, again, what we spoke about that true and the highest form of order arises from chaos. Thou shalt not get a better order aside from obtaining it from chaos. Or am I lying? Or am I lying? So first of all, right now, I do not care how old you are. But when they said that everyone should be indoors way back in 2020, even my father was indoors. Right now, you can't tell him to go indoors. I get it, someone with higher authorities no longer tell, you know. But for you to be able to have the highest form of order, it must arise from chaos. There must be a predetermined outcome from that set chaos. So there's a thesis, which is a problem. These people are moving around too much. They're creating a lot of carbon footprint, all these things, you know. Pharmaceutical companies, we're not making enough money from these guys. They're not getting as sick as we thought they were. They're adapting to something. Now, let us introduce a virus, which is a thesis, you know, which has a predetermined outcome, and there is a solution at the end. If you understand the Hegelian dialectic model, is that like each and every step is complete. You've got a thesis, you've got an antithesis, you've got a synthesis. That means that all three of them, before they are complete, it's like you're submitting a paper for your research. It has the beginning, it has the middle, it has the ending. Are we okay? So the same thing. So now when you start seeing a push to the upside, now you have to understand the incentive behind this. As the price push to the upside, obviously majority are going to jump in based on the fact that, oh, it broke above a higher high. Because everyone always has a reasoning on why the price has to continue a bit further to the upside, isn't it? So you just give him a minor consolidation. And then once you break above the intensity itself, it pushes him to get into the trade. It's like seduction. You know, seduction, it comes in rare forms. You understand? Seduction is one of the things that come in rare forms. Right now, if you can go to coffee at, what's coffee? Coffee at mid-rent, you will understand what I mean when I say that seduction comes in multiple forms. But let's leave that for now. So, but you understand what I mean? There's always something that can seduce a person into acting out of order, you know. So now let's look at this situation right now. So now you get a strong push to the downside itself. Okay, it constitutes of the forced liquidation, because now you start seeing aggression to the downside. Automatically you're saying what? This market has the probability to push to the upside, but yet your brain says retest of the level in which the market broke out of. That it's ringing in your head because someone on YouTube once told you that if the market breaks a resistance, it now becomes a support. Okay, guys, I want to ask a question. I want to ask you a question. So right now, just tell me, let's say maybe I'm Superman, I'm able to fly upwards, right? And then I break my ceiling. Can that ceiling automatically now act as a like the tile, the ground? Is it possible for it to act as a ground? Already the structure is weak. So how can that weak structure be able to support me while I broke it while it was strong? But there are so many materials that are written on how a support becomes a resistance and how a resistance becomes a support, which is nonsensical itself. But the thing is that, like, once you tell people lies too often, they will eventually believe it's the truth, right? So, but now let's look at the behavior that is currently occurring on that set consolidation. You've got multiple retests of a set consolidative state. Ask yourself, why is this market coming to this area multiple times, but yet failing to break it? Because there is someone who has rooted himself in believing that the support emerges from a resistant and a resistant emerges from a support. And that is something that is very dangerous. That is something that is very dangerous because now you're confusing yourself, right? So now you get a lot of people entering positions in this area here. So now this, it's an explanation of a consolidation, but it comes in a more sophisticated way, right? So now, again, you look at this area here, you've got a consolidation, you've got multiple people trying to execute take positions, right? And then, you know, our favorites are there located, and, you know, they were there, and, you know, they were chilling. This is them. What do you think? Eh? What? This is before I started trading. This was what? 2012. What was he seeing, this guy? Way back in 2012, before I even started trading, this guy, what was he seeing? What was he seeing? You're seeing it. What was he seeing? What was he seeing? Let me show you what he was seeing, this guy. So this thing haven't been working since the dawn of time. It's not me, it's them. It's not, you know, when sometimes you have to just look at the market and say, you know what, it's not me. So these people have been seeing the same structure, same pattern for years and years and years until this day. The same things, year in, year out, month after month. So now you're telling me that I should base my future on technical analysis, while itself it has been proven to be a liar. Hey, this is not a conspiracy theory, guys. Hey, I sound like a conspiracy theorist now. But I'm just saying that since the dawn of time, when men were still fishing for a living, again, I'm just saying, this is what he was looking at. And he had the belief that this is a false breakout, you know. This is the belief. It's very intense. You know, when a person believes, the intensity is far greater than logic. When man believes, you cannot change his mind. It's intense. It's rooted in its DNA. So, okay, now we actually seeing this, right? So obviously, when the market got into this area, there's still a belief that the market has the need to continue running, right? So now you get into a situation whereby a consolidation has formed. But the question is that the area in which the consolidation forms That's something that is very important. So because now if you understand that here, this was a high that was created, that means that it's an all-time high, isn't it? So if it's an all-time high, no biggie, no problem, right? But based on the Dow theory, the market is still considered to be in a downtrend up until a low that was formed has been significantly broken. Where am I now? Okay, there we are, right? So in a more technical sense, we will say that this is the swing low, right? We will say that this is a swing low, right? Though we have multiple swing lows that are located at around, but like we're going to say that this is a swing low, right? So you saw a push to the upside, very aggressive. Now the market from the high, and then now you have that drop, right? But the thing that I like is that everything that I show you is something that we can actually put it that side in the current market that is currently occurring, what is currently occurring. So right now we said that the last quarter, the last quarter, it is the Friday of the year, isn't it? Okay. So now the market has been rallying since, where is it? Okay, this is 2013, 2012. September 2011. I was doing my first year at TUT. We're bad, man. Okay, Chen. Right. All right. So now you get to see not the beauty. Ne? Sorry. So you get to see the beauty, which is the art of trading. Isn't it? Such a majestic thing, right? Beautiful. Look at the candlesticks. Thick. Hey, guys, focus. So now we saw the market continuously push to the upside, right? So we've got the first quarter. This is the last quarter, which is September, isn't it? Right? And then the market continued to drop up until we can say like, yes, the whole I think this is the third quarter, right? Because we said that the market, we're going to divide it into 4 quarters, right? I said that like you can divide it. Okay, I prefer to divide it into 3 months log so that I can have 4 quarters. There's some that choose to divide it into 4 months so that they can have 3 quarters, isn't it? But like, let's choose the one that is more, we'll decide in the future which one we prefer, but we can still play around with both of them, but let's focus on the 3 ones, right? So this is towards the end of the year, right? Our Friday, right? September is a young Thursday, right? So you get a reversal of the move. This is something that I like, based on where this thing is located, right? Based on the fact that we have continuously been pushing to the upside. We pushed to the upside, we got into this scenario. The move, we retraced how much? 50%, but we managed to tip into the 60% time, right? But yet to end the year on what is that December thing? Okay. December, we ended the year back below the 50%, right? Are we okay with that? So that means that like right now, guys, now let's look at this. Let's look at this. Ne? Please do not be confused. If you need glasses, go get your glasses. If you're wearing contact lenses, this is going to be required, right? So now the question arises, we said that like on the DXY, we want to see the DXY at least closing above the 50%. No matter what happens, we need to close at least above 50%. Are we okay with that? The reason being is that like if we closed above the 50% of the like we have to close around the 70% percentiles, the 60 percentiles. Remember that the main objective of us closing at least above 50% of the entire move that occurred throughout the year. Now this, what it does is that it makes the high that was formed throughout the course of that year more vulnerable because I'm closer to it than I am to the low that formed. Do you guys get me? Or maybe I should use my native language because like maybe if I use Spedi, let me wish about it. I'm bad at repeating, my brother, you know. I speak from the heart. I speak from the heart, my brother. So whatever I say, I forget same time. That's why, like, even sometimes when I watch my own Zooms, I'm learning. Because like once you like when you like I speak from like subconsciously some of the things. So some of the things I don't even know that I know them until I start a Zoom. So that is like I think I need to watch my Zooms again. So especially like Classic 11, I genuinely need to watch it because and even all the Zooms, I still need to watch them. I really need to rewatch all of them because I need to learn as well, you know. So, okay. So now if that is the case, and we're looking at this and we're saying that, okay, this year, you see here, this is the 26th of November after Jesus' birthday, which is the 25th, isn't it? So the market itself, this is the ending, if I may put it that way. That means that the market throughout the course of the year, which was 2011, the market pushed to the upside and it continued to push to the upside, right? And then when we got towards the last quarter of the year, the market retraced. So, and upon that retracement, that reduction in the value of gold, right? The market closed, managed to lose, if I may put it this way, managed to lose more than 50% of the gains it made throughout the year. You guys get me? The market managed to lose more than 50%. So now, if we are at this level here, remember, we are at an equilibrium, we are at a price level whereby like everything is just pish posh, everything is proper. Meaning that like if we are saying that the market is made up of 100 people, 50-50, don't wish it. As millennials say, relationship is 50-50. Eh? 50-50. So this is basically like what we are seeing. So once you tip the equilibrium scale, we are in this, we retraced 60% of the move, meaning we lost 60% of the gains that we made throughout the year. So now which one is more? Where are we close? Once the market is here, once the market is here, which one is closer? Guys, don't be confused. I'm not worried about other lines. Focus on what I'm doing. If you're following me properly and you're not texting someone and asking her what time is she coming, then you should be very focused. You can't multitask. I'm already enough for you. At this moment, you don't need any other. I'm already stressful as it is. I'm stressing you, I know. Focus on me. Don't focus on another person. You'll be twice the stress is not right. So we understand that the law, based on this, it's actually, that means that like if anything should break, it should be this one, not that one, isn't it? Okay, that's nice, ne? Very cute. Ne? Very nice. Forex is very nice, guys. Come on. So, okay, now we have a new year, obviously, but the incentive was already laid out for the upcoming year. The main objective was to liquidate this low. That means anything that does, okay, we do not want to see the high being liquidated. We want to see the low being liquidated, provided that the fact that now as the market pushed to the upside throughout the course of the year, we managed to lose 60% of the movement that was made, or the profits that were made throughout the course of that year. And we lost all those things within a short period of time, which is less than 3 months. What the market took, the market took 9 months to make, or 8 months to make, it was reduced to ashes in less than 4 months. What it took 8 months was reduced to ashes in 4 months. It's beautiful, isn't it? It's poetic. Okay. So now let's get into this, guys. Let me not confuse you. Let me bring you back to speed. We're looking at this area, right? So first of all, this is the yearly low that was formed, isn't it? It's very beautiful, isn't it? December. Actually, we didn't even form a low. So this is the previous year's, the previous quarter's low, you know, the previous quarter's low. This is the previous year's high and the previous year's low, right? This is 2011. You get into a scenario, you get into a situation, né? Right? So you find yourself in a bit of a consolidative state. So the main objective is to do what? You've got to push to the upside, the market push to the upside. Obviously, this is the key area. So that means that we do not want to see the market breaking above this area, right? This is still an explanation on consolidation, by the way. It's just more in depth. So you get into a scenario whereby, like now, the market, as it continues to push to the upside, you've got an overwhelming sell pressure that pushes price to the downside. Ergo, formation of a resistant level. The price continues to drop in price. Now, what occurs? You've got an overwhelming buy orders coming into the market, pushing price to the upside, resulting in the formation of a consolidative state, isn't it? Meaning that, like, even if we did get a push to the upside into this region here, right, we will still consider taking short positions. Why? Because now, if we are looking at this entire scenario situation, let me just do this. If we are looking at this entire scenario or situation, first of all, we are currently trading within the second leg of the 3 cycles that makes up a wave, right? Okay. So now, again, we see the market pushing a bit further to the upside, right? When it gets to this area here, there's always that overwhelming pressure. But the nice thing that I want you guys to see is that I want you to look at the audacity. I'm just playing, guys. It just came to my mind, the word audacity. But I want you guys to actually look at the way the excess prices form below and how they form on top. Do you see it? Look at the intensity of the excess price forming below and look at the intensity of the excess price forming above. Look at the strength in which the market approaches the set support and look at the strength in which the market approaches the set resistance. So now, let's say that this is a wall, right? Let's say that this is a wall, right? Let's say you have a hammer, hammer, you know? So this is the wall that you want to break, right? First swing. When you take the hammer behind your, like on your, like, bargain, we wish them raw, we force you are again. So you're throwing it again, like you have to build up a certain movement, right? You have, you know, the movement, guys. So you have to, you know, put your back into it. But when you take it, when you hit the wall, and then when you try to do the same procedure, the way back or away from the wall, it's not going to be as fast as the way into the wall. English, English is throwing me off. I'm running low on data. So what I'm saying is that, like, when you are hitting the wall with a sledgehammer, the speed in which you actually like move away from the wall before hitting it is not as intense as the speed that you use when you come into the set object, the one that you want to break, right? So there you just take it properly, because if you overswing it, it's going to hurt your back. Next thing you know, you have to apply for social grant because you are unable to work because of your back problems, isn't it? So that's the same thing that we can see here. You take it back properly. When you come back with veracity. You take it back properly. When you come, this basically shows you that the incentive is to liquidate the low, but yet there is a lag. Not necessarily a lag, but remember, when we spoke about the force that is required, right? In order for one to move an object, a stationary object, a car. So the amount of force, if you push in the car, it pushes back the same, it exerts back the same amount of force that you're exerting onto it, right? And then again, you add a second party. Let's say you're applying three together. You add, the car is 3 as well. You add a second party, that's the second party is weak. Maybe it's like, you know, but you get it. So eventually you're going to have to build up enough momentum in order for you to be able to break or to push the car. So that's basically what has been occurring here. So you've got multiple people coming in, protecting their orders because they want to see the market continuing to run. But though if we have had a forced liquidation around this area, the intensity wouldn't have been that severe. We would have seen a push to the upside just to liquidate this area before the drop in price. But again, you look at how multiple times, how many times this area was retested, then now you get to understand that the probability of further drop in price is there, isn't it? Especially here, you saw this, right? So now based on that, coupled with where this thing is located based on this area, on the movement of the year, and then now you can actually expect the forced liquidation. So we have 1, 2, 3. So now the intensity comes from the fact that now this area was protected multiple times. Therefore, you have majority of people placing their buy orders because they want to see the market continuing to run, right? And if they are very creative, you know what they do? Sometimes they do something like this, right? And if you find them on their days where they are feeling more and more artistic, what they're going to do, they're not even going to do that. They're going to do something like this to tell you why it needs to go to the upside. And, you know, when you go to UK, they call it an outer structure, an inner structure. So they will tell you this is a continuation pattern. Those that are from UK, my apologies. You know, they will tell you, but again, is it a pennant or a flag? It has to go upwards, right? Hmm? We're talking about creative geniuses here, people who made millions. Hmm? And it confuses them, these things. You know, the amount of confusion. I think that a person is in an asylum, is in a mental institution, because they're forever confused, because everything does not agree with what they need. It's just a mess. Hmm? It's just a mess. No, it's a false breakout. Hmm? Find them happy. They're very artistic. Hmm? By all means. But you get it. There's so many things that can be used in order to justify whatever you want to see. But like what I can tell you is that there is no such beauty as seeing the market in its form. Wrong. You know, everything is nice, ne? Hmm? Everything is nice. Hmm? Ask people who drive without a seatbelt. Hmm? They will tell you, a seatbelt, you know, it hurts me, you know. Ask them, they know these things. They don't like safety, but it's okay. You know. But again, but like everything is nice that way though. But I'm saying that like right now, when you look at the market, its most entirety in its most simplest form, you are able to see that the probabilities can be in your favor, right? Everything can be in your favor. You just need to see the market in its entirety. Yes, sometimes you're going to get extensions, you're going to get spiked out, but that is the thing of having a small account. Do not beat yourself up because you got taken out. You have a small account, you have no choice but to try and pinpoint where exactly the market is going to reverse. But you can't be wrong on a higher time frame. Rather be wrong on a 1 hour. You know that within 3 hours, you are out of a trade. Right? But again, now the main objective is to complete the last leg, right? There. Now, the intensity itself stems from the fact that you have had multiple retests of this area. So you've had multiple people trying to protect their accounts. And also remember that like as price continues to reduce in value, not only are people being liquidated out of their positions, but some are seeing a reduction in their profit margin, right? So they're seeing a reduction in profit. So what are they going to do? They're going to forcefully liquidate themselves out of a position because they're seeing a reduction in the value of their set portfolio, right? So now that becomes a bit of a problem, right? So now you understand the intensity. The intensity does not actually come only from the fact that people are selling, but it comes from the fact that people are being liquidated out of their position. So now as the price was dropping here, there were people who caught this and pushed up and came back again. So those that already bought at this area here when the market was pushing to the upside, what are they doing? They are trying to hedge against their losses. You see their account is in a negative, right? I think we all see these things on Instagram, right? You see a person having buys here, and then he has buys again here, and then he has buys again here, and then finally he gets buys at that level. He's hitting here, he's hitting here, he's hitting here. He's only making profit here. But remember, the velocity, the amount of gas, the lever, you know, the goal he had when he was entering position here, it's far greater than here. Here, he is in death. Here, he was partially, but confident it will come back. Here, he lost hope. Here, he's just hoping that the account will survive. So already, the first entries, they have more, you know, chip on the shoulder type of things, you know. It's done with a head raised up high, you know, confidence. Once you knock someone's confidence, it's very difficult, né? So even though they're trying to hedge against their position, they're already in a loss. So the intensity of entry here is not going to be the same as here. You get me? So that's why we're seeing that the forced liquidation process occurring. So now it shows you intensity because now it's coupled with fear and greed. The fear that I'm going to lose all of my accounts, so I liquidate. The greed that I cannot let this market beat me, so I do not liquidate. And I'm forced out of a situation, isn't it? It's very nice, ne? So now once you get into this situation, the break below here, there's a reason why it breaks, because it has to break someone. So now you start to see the market pushing a bit further to the downside. But hey, hold on. They recognize there's a certain element of recognition that the brain does. You know, the brain functions in mysterious ways, you know. One of the best computers that has ever been created, and there's nothing that can ever come close to it. The brain recognizes pain. The brain recognizes pain. So if the brain recognizes pain, what occurs? That means that now the intensity of the breakout is not going to be roughly the same because this person has experienced the pain that is attached to a consolidation. Already the stigma has changed because now based on the Dow theory, this market is proven to be in a bearish trend, but the proof comes later upon the forced liquidation process, right? And the nice part is that now they're giving him the ability. There's a certain element that comes with the ability to do this. There's something called the outer trend lines, and then they have something called the inner trend lines. Ne? You know, the thing about a trend line, what it does, ne? The trend line, it basically like, it has to, the rules of the trend line says that like, it is drawn by connecting two significant peaks or two significant troughs. Ne? But they omit the fact that those two significant troughs and peaks, their formation are coupled with time. There is a certain time that must pass. And when that time has passed, you know, you all know, the trend, it's better to write the trend at an early stage, right? For example, you can't buy an NFT now. Could have bought it back then, can't buy it now. Right? So, but basically that's it. So now, one, let's just take this and remove it and let's give them what they need. One, maybe two. And you know they have inners, right? So here, the second one, this is not the point to buy. This is the point to buy, the third one. Right? So now, again, if you look at it, the intensity of the breakout out of this consolidation is based on the fact that majority of the people are considering taking long positions. Here, I'm saying, oh, sorry about that. Majority of the people at this consolidative stage, they are considering taking short positions. So you've got a lot of people taking short positions. You know why? Because they are in a choir. And in that choir, they sing hymns, higher highs, right? Let me show you the hymns. Let me show you the hymns. Very, very, very spiritual. Higher high. Higher low compared to this low again. Lower high. Lower low. Same way they're doing that. It's like it's very interesting, you know. So once they are in a position to start singing higher highs, higher low, lower lows, lower low, lower highs, all those things, what it does is that like now it already hinders them from thinking that the probability of a reversal might be there. Because first of all, they have to wait for the market to break above a significant high before it can be considered a rally. But the fact that the market continues to break swing lows, therefore, it means that the bearish side is still favorable, which in the case, it might not be the case, right? Because first of all, when you break out of a consolidation, the lack of intensity can already tell you the saturation when it comes to buyers and sellers, right? So in a market that is filled with, in a market that is saturated with buyers, the best way to position yourself is to become a seller, isn't it? And in a market that is saturated with sellers, the best way you can position yourself is to become a buyer, because there is legitimately no competition over like if you are a buyer, there are a lot of suppliers. You've got a lot of people that are selling that said asset, right? So you continuously buy it from them. But if you look at the two scenarios, this consists of a lot of buyers and fewer sellers. This consists of a lot of sellers and fewer buyers. Are we okay with that? So this is the difference between the two consolidative states. So the intensity of the breakout, it's not going to be that intense, because in a market that is saturated with sellers, they are looking, who am I going to sell this to? No one is willing to. There are few people that are buying. Are we okay with that? If you want to see that there is a competition over buyers, go to Rabi, January. You see January, before people get paid, go to Rabi. In fact, don't even go to Rabi. Go to Sunnyside mid-month before people get paid. And when you just walk in there, you'll see, hey, Sisi, don't you want to make your hair? Don't you see those things? They're competing over clients because they have to, they are not clients that are coming in at that particular time. So when there are too many suppliers and fewer consumers, you get it though. If you don't get it, forget about it. I'm playing, guys. But like, you guys, are you guys following? Are you guys following? But I'm saying that, like, right now, when you start seeing those type of scenarios, like, for example, this is a scenario that is it's observable. It's a scenario that is observable. You've got a situation whereby, like, the market continues to drop in price. As the market continues to drop in price, a saturation of sellers cannot push the market to the downside. If you wanted to push the market to the downside, there must be an incentive. There must be an induction phase that's going to result in buyers coming into the market. There must be an art of seduction. By pushing the price to the upside with a certain momentum, speed, then you have to get people jumping in very late so that you can be able to liquidate them. Then when you are liquidating those that jumped into the buy position very late, they automatically add the sell side liquidity, pushing price to the downside. So here you have never seen a high being broken. So even if you break the low, it's not really that deep. Again, so now when we see the price pushing to the upside again, when the price pushes to the upside, though it breaks that, there are certain highs that are very, very, very important, right? So now let's look at this area here. You push to the upside, you get a bit of a consolidation, and then a push again to the upside. But yet again, now this itself, it's like rotational, ne? It's like rotational. Look at this. It's thick, ne? I like it. I like it too. Beautiful. So now this entire area, it now becomes a consolidative state without even saying that it's a consolidative state, but it does become one, right? And then when we look at it in terms of mathematics, we're going to say that the left-hand side is equal to the right-hand side, right? When we look at it in terms of mathematics, because the characteristics are roughly the same. The characteristics are roughly the same. Please don't say that it's an inverse head and shoulder pattern. Okay, it's all right. It's all right. But we're looking at the characteristics of a set consolidation. And we see the way it's approaching this area. It's like it's no key. The same as here, but less intensity. You know, the same as here, but less intensity. Just, you know, you're knocking soft knocking, you know, not too deep. Just right, you know, not too deep, just right. Then we start seeing the market pushing to the downside. Again, at this level here, the push to the downside plays a very key significant role, because as the price continues to push to the upside, you look at this area here. As the price pushes to the upside, the intensity of the break above the set key significant area, not just only key significant area, but this is the high that was broken in a long time. That means 2011, when all these things was, meaning that like ever since 2012, this is the first time a high is significantly broken. I'm talking about a significant high. That area that everyone was looking at. This is an area, because remember again, so remember again that like the amount of force that is required for one to break above a key area, it must be far greater than the amount of force that is preventing the opposite force. That means if you're going in the direction of bullish. Okay, sorry for that. I lost connection, right? I lost connection. Is my connection okay now? I didn't lose connection. No. They want to bewitch us. They don't want to see us in the Zoom for this long. They don't like that. You know, they don't like the Zoom being this long. I don't know why they do this, right? So now you see the push to the upside, right? The aggression that comes with that, right? So first of all, the same thing that we spoke about, right? The same thing that we spoke about right now, the intensity, the amount of energy required for you to push a car, it should be high. Né? If you're pushing it over a hill, once you get over that hill, trust me, you are sweating through your back, you're sweating through your back because you are tired. You have used a lot of energy, right? So that's why we get to see a bit of a consolidative state. You get to USA a bit, right? So here we completed the 3 cycles that makes up a wave. And then we got into this area. Now this entire area now becomes an area that has been tested multiple times, right? The question is that how is the market coming into this area? Obviously, everyone is looking at this area now as a point whereby it should be retested and the market needs to reject it. The same thing, once the market spends a certain duration in a consolidative state, now this becomes the right-hand side. This is the left-hand side. Are we okay with that? So here we had 3 cycles as well, pushing price to the downside. We have a reversal pushing price to the upside. Are we okay with that? Because now the thing is that like once the market breaks below a key significant area, such as this one, this here, it came with intensity, but the speed reduced. So now this gives you an opportunity for you to buy. Again, we push to the upside, a bit of a consolidative state. Why are we consolidating? Because we're consolidating around a key significant area, which is this level that was broken, isn't it? Because people are looking for a breakout and a retest and a drop in price. You get another consolidation. The same characteristics, still the same, based on the location. The same thing now. I think everyone now gets how a consolidative state is formed and the location, the role it plays. Same as here. This is a bit intense. The same principle that we have discussed, guys. It's here. Might be a bit messy, but it's there. It's there. And you know, the nice thing that I like about this is that now you see here, look at this. You see here, multiple retest. Now here, legitly, here, multiple retest. Why one? You see it is there. The intensity pushed to the upside. That means that this intensity here, hey, Jesus, okay. January. Okay, this is the yearly low, right? 2020. This is the yearly high, right? Okay. It's nice, ne? Hey? Hey? Guys, are you following? Should we stop? You must tell me, man. I must not overwork you, but I must overwork you, guys. Next year, but I want us to do great things, guys. So now you see the same thing that I just showed you there. Nancy. Nanzega. So technically, we still need to at least push a bit further to the downside. Might take more years, but similar to here. You can look at this net. I think it was July, January, 2010, right? 2011, yeah, here. Net 2011, yeah, move push to the upside. 2012, consolidation. Net 2013, breakout. Meaning that to break to reverse to legit break below this level here, it took 3 years. Ne? It took 3 years. Ne? Okay, sharp. Let's go here. 2020. Ne? 2020, it came back to this level here. 2021. Ne? 2021. The law was created when? Feb. Okay, no, not Feb basically, but like it didn't end the year where it needed to end it, but it ended it roughly sketching out. Okay, sharp, no problem. So now that means that like if we're going to look for a breakout 2020, 2021, 2022, so it should have occurred this year properly, right? So we're going to give it an extra extension, provided that the depth of the push to the upside, it was far more intense as compared to the initial one. Though they have roughly the same characteristics, but we're going to give it, you know, a benefit of the doubt. Now we're going to give it a benefit of the doubt. Now, not doubt only, benefit of the doubt. Yeah, we're going to give it a benefit of the doubt. But yet again, in the very same light, we're not going to omit the fact that this itself, as the price continues to push to the downside, yes, to the downside, we're not going to omit the fact that like the probability of a break above that area, it is there, provided that we do close in the 50%, above 50%. Hey, it's a very tricky situation, hey? 2 more weeks to go. It will be nice. I want us to close at around this area, guys. That will be very nice because now it actually gives the probability of the break of the low. You know, it gives us at least an opportunity for us to short this. But basically, the things are roughly the same. Ne? The things are roughly the same. They are roughly the same, but I digress. So, in a nutshell, because we have been discussing this for quite some time, we're going to look for possible reduction in price roughly around that area. That would be nice if we do get that next year. That would be nice if we get it next year. That would be nice if we get it next year. We don't want it this year. This year, we just want to see it playing around this area. That means that whatever the market does this year, this is not something that we want. We do not want to see the market breaking above 1840. Ne? Or even if it comes to 1840, it must just play around that 1840 level. We don't want to see it breaking above it. Again, and we understand why we don't want to see it breaking above. Because we don't want to be closer to here than we are to there. We want to be closer to the low than we are to the high. Or at least put us at equilibrium. Very nice, ne? So basically, that will be something that we discussed, but we discussed it. So now we'll probably be looking for the market to continue to drop, maybe into this region here. That will probably be something that is very nice to observe. But in terms of like taking short positions, definitely going to consider taking short positions roughly around this area here. So this area can actually provide good short positions while in the very same light maintaining proper risk exposure, right? It's not that deep, guys. Okay, there we are. Next. So that area there next year, 1940. So we don't want 1840. Right. Right. Are we okay with that, guys? Oh. Are we okay? So if we are okay, guys, that's very well we are go seeing. So basically means that I've explained this consolidation. Wow, it took me time for me to differentiate between the intensity of a consolidation. Yeah. It did take time just to explain these two scenarios. 1 hour, 30 minutes. Guys. tshwanetse regular 6 ya corona ka mokgwa no get list ke ishe marapo fase. Okay, so now what we'll be looking at here again in terms of its intensity, the intensity, it is there, like it is intense, though like the thing is hidden within a consolidation that just recently formed. It's still okay, because like now if we're going to compare the two intensities of the breakout, right, it's not the same. It's not the same at all. It's not the same in terms of intensity. We're not talking about, okay, I think right now, if we're going to look at it in terms of intensity, okay, we understand that we're going to look at it in terms of the volatility, the momentum in which it breaks out. But like that, again, it's a factor of the forced liquidation process, depends on that. It cannot be compared to this, because like already this came with a certain element of fear. Or am I lying? So already this liquidated more as compared to this one. So already the element here, it's not the same as this one. Because first of all, you have to understand that like, okay, now when the reduction in price occurred at roughly around this level here, right? Where am I? Okay, sharp. Now let's look at this area now. Let's look at this area now. Ne? So when we're looking at this area here, okay, consolidation, the intensity, okay, now we have to set a precedent, right? So the intensity of a consolidation matters more based on the location. Are we agreeing with that? The location determines the intensity. So if the consolidation does not form at the top, we cannot justify its intensity. Okay, we can justify it though, but I'm saying that like we cannot really rule it as an intense breakout. Because first of all, this itself, though it's a consolidation, the intensity is not that great based on the fact that we had a swing low that was heavily liquidated initially. So the snowball effect resulted in the mass liquidation as the price continues to drop in price. So ergo, this liquidation, it's not that strong. This is like you got again, I don't know. I don't want to, like, it's like, I don't know how to explain. It's like a car, and like you're driving a car, it hits the first wall, the second wall, the third wall, it obviously loses momentum, loses speed. You know, it's so far that inertia can take you. It can't take you forever. Like it's just, at some point you have to stop, depending on how many objects you hit at that road, along the way. You know, so here you came with a strong momentum, you hit the first one, the second one, obviously the third one is not going to be as intense. So again, we'll say that it depends on the location as well, because now if we're looking at these two things, they're roughly alike, right? But the intensity of this one, this is the one that is more significant, isn't it? So this is the swing low that is more significant. So even once you hit this one, this is the second one, and by the time you get to this one, you're already tired. Ergo a consolidation, but we already had that intense move to the downside. So this one could have been more deep, but hey, again, remember, once you spike below consolidation, the break below this area here, it was intense, but again, remember that like the lower the prices, the lower the prices are, the more suppliers you have. Are we okay? Because like they'll probably be running a business at a loss. So you have more willing buyers at the lows than you have at, actually you don't even have, because like in general, in real life, you have more willing buyers at lower prices than you do at higher prices. But in terms of like business wise, right? So people will only buy once something starts picking up and it's hyped. That's when they're going to start getting into the market and buy. So for example, right now, they were not buying here, but they bought here. I wanted to buy at 1, I think. I think there's a chart that you can check GBP USD. I think it was still here. I wanted to buy at 1, but it never got to 1. So I never actually bought it because I wanted to buy it at 1 because 1 was more pash. I wanted it to be more intense. So right now, we'll just be looking for possible shorting opportunities at roughly around this area here. The main objective is to liquidate the yearly low. But I'm saying, no, lower prices, you don't have more willings. Like the thing, okay, at lower prices, like, okay, maybe I'm looking at it in terms of an economic point of view, right? In terms of an economic point of view, right? The only time that the prices starts to rally, it's when demand exceeds supply, right? So the demand of that exceeds the supply. That's the only way you're going to be able to sell as a supply. There must be fewer competition. But if there is competition, it's very difficult for you to move units, right? So you guys get what I mean? So that means that like right now, like when the price is dropping, if you are a supplier, you automatically, like some of them, they lose money. For example, okay, let's look at it from, okay, simple illustration, right? So guys, 2020, before the lockdown, before the lockdowns, right? Before COVID, that's the thing that I like using that because that sets, it shows you the relationship between supply and demand. 2020, how much was toilet paper, 2-plier? Let me just check it, right? I want to check for you. So they say that, like, guys, is everyone following? Or you guys are tired? So they say that like the demand grew to unforeseen heights in March 2020 with 1.45 billion in toilet paper sales in the 4-week period ending March 29, up 112% from year before, according to IRI, America. So basically, it means that like the pricing of toilet paper increased. Not like they were not producers of that set toilet paper, but the amount of demand, it was unmatched. So now the pricing of toilet paper will remain stationary until you have something that forces it to increase in value. And the pricing of toilet paper has been stationary, right? So basically it means that like, if you get into a situation whereby now, for example, right now, upon that, a lot of people, maybe they started toilet paper manufacturing companies and what. Yes, 2020, you could have made a killing. But right now you can't because there's too many suppliers of toilet paper. While everything returned back to the norm. Everything returned back to the norm. People are still buying toilet paper the way they used to buy them. But when right now you've got inventory on hand, so the company is running at a loss. So that means that like that basically that's if you look at it from that perspective, similar that to what occurred. The only time that price increases in value for a set asset, it's if the demand exceeds the supply. That's why people were fighting over toilet paper, because the demand exceeded the supply. People can't fight over toilet paper if the supply is there. Or am I lying, guys? People made a killing selling hand sanitizers. I would have thought. Who would have thought? Eugene, I buy 1 million worth of toilet papers at work. Probably like the tender. At work, 1 million. Hey, you're killing the company, man. Hey, probably $10. You know, in South Africa, everything is expensive, man. I'm telling you. It can, to patch a road, it can cost $1 million, but in actuality, they just pour a bag of cement that costs 90 rand. But it's just how things are here, right? So, but like I think like that's basically it, guys. So here, let's finish up with this so that we don't have to do it tomorrow. Probably if we do have a subs, guys, you guys are killing us, guys. So basically, like again, let's look at this is on a weekly time frame, right? Again, simplicity, guys, simplicity 2021. Okay, here. So whatever we do, we must end the year here. Nah, whatever we do, we must end the year here. And it seems like it might be a probability to end the year here. So we want the reduction in price. Whatever we do, we must end the year here. I want to write there. That's right. Because the incentive is to break below this low, right? This is from 2021. So from 2022, where does it start? From 2022, it's here. So we actually we retraced more than 60% of the initial move, right? But we'll see how it goes. We'll see how it goes. Okay, this is where we started. Yeah, we are near 50%. Thank you guys for coming. We will talk more on Telegram. And unfortunately, this session is going to go straight into Classic 11, right? That's the unfortunate part. Shout out.